to Dollars, Dirhams, and Our Two Financial Cents, our podcast on all things finance and wealth. My name is Anselm Mendes, and we bring this podcast to you from our studios here in Dubai. In this series, we're going to explore topics ranging from financial planning, wealth accumulation, and how to save and accumulate and grow your money. This podcast is brought to you by the Continental Group. Continental is a leading insurance and financial services provider with access that provides you access to over 10,000 different securities to world's leading platforms on the investment side, as well as a wide range of solutions on the insurance side. Our qualified team of advisors is able to work with you to look at your financial lifestyle and provide you with solutions that meet your goals. Our guest for this episode is Mr. Abhishek Datta, Vice President Advisory at the Continental Group. Abhishek has been in Dubai since 2010 and has been in the financial services profession for over 13 years. He advises and talks to clients about wealth management, investments, and various other lines with regard to managing and working on their finances. So, Abhishek, welcome to the show.
Thank you. Thank you for having me, Anselm.
And did I get everything right about what you do? Is there something that I missed out?
I think it's been 14 years now since we're in 2021, but otherwise everything's right. One thing that I like to highlight is my job is to simplify someone's life. Mm-hmm. And when I say simple, a lot of people assume that means it's easy. It's not. The point is, while it might seem simple, it takes a lot of discipline and a lot of work behind it. So that's my primary objective when I deal with anyone, any client for that matter.
Sure. No, that's good to know. And like you said, while it may sound simple, it's not easy. And I think that's what a lot of people find with finance, especially when they're getting started. The concepts seem very simple, but like you mentioned, discipline and following through are the more difficult parts of that. Right, let's get into it. I want to take you on a little bit of a journey. So let's imagine we're back in 2020. Of course, the pandemic hit. A lot of people found themselves in a financial situation that was not very pleasant. So I'd like to ask you, imagine this is April of 2020. People are losing their jobs, clients are losing or getting pay cuts, and finance is seemingly becoming tough all across. How did this impact you on a personal level? I know as a financial planner, you would have your view, but on a personal front, how did this impact you? What were the thoughts going through your head? How did you see this as an occurrence, and how did you cope with that?
So I would like to go exactly a year back, and on this very day in 2020, we were celebrating my sister's wedding in Bombay, and we had a phenomenal time. It was everyone was feeling on top of the world, and in a few days, everything changed for us. On a personal front, we had a loss of life in our family, and we had to fly back to India. And since then, we were stuck in India for 6 months. So, I've realized, and it gave me a lot of time to think, that it's not just a financial crisis; it was kind of a human crisis for a lot of people in the world. And finance is an aspect of our lives that we can't ignore. Now, when you are away from the safety of your own home and you don't know, you have no visibility about what's going to happen next, it is challenging. It is challenging to stay focused, stay motivated. And I think that helped me empathize with a lot of my clients when they were either losing jobs or their businesses were not doing well. They were not able to make payments to different products that they had. And it was challenging for sure, but we tried and kept our goals in mind whenever we made a decision. So correct. I think that helps when you're clear from day one that what is it that you're doing this for. Now, if for anything in life, if you know that this is the destination that you're heading to, it motivates you to do better even in a tough circumstance. So say even in life, like if you were training for a marathon, for example, it's tough, and I've tried it. Not that I'm a very good runner, but it's tough. But those people who succeed are the ones who stay the course, and they don't let circumstances bring them down constantly. So even in financial services, I think that is the way to look at it. If you've got that goal in mind, and we can figure out solutions to help our clients in those cases as well.
And do you set your goals at the beginning of the year? When do you sort of, and what is the sort of process that you go through with regard to setting your goals? And do you do that separately for finance as well as for personal life, or how do you go about that process?
So, I try not to focus too much on numbers, but I do have personal goals. I was thinking that day there's something that I want to learn this year is probably how to ride a bike, and I don't know how to do that, and I've been putting this off forever, and this year I'm going to do it. But on the financial side, I think it is good to know your destination rather than try and control things that you can't. So, for example, the pandemic made us realize the importance of emergency funds that we need to have. Now, a lot of people have put numbers to it, like 3 months or 6 months of savings that you need to have, but in my opinion, it should be the amount of money that lets you sleep peacefully at night. So if it's 3 months for you, if you feel that if you get fired from work, which is the worst thing that could happen, then if you can find a job in the next 2-3 months, then your 3 months of savings are enough.
Correct.
Whereas if you have a life-threatening illness, then you need to have critical illness policy in place.
Correct.
So these are the kind of goals that if we understand and our clients understand, we can help them set these in place so that they don't have to worry about these things every day.
Absolutely.
So a goal-based plan is better than a financial plan, in my opinion, because goals can keep changing and financial situations can keep changing, but we have to stay the course and focus on what the destination is rather than the journey itself.
And goals tend to be a little more longer term in nature than the typical financial plan possibly.
Yeah,
that's good. And do you work with your clients as well for sitting down and getting this process at the start?
So the every first meeting for me is trying to find a little more about the client, because a lot of times clients don't open up to you easily, and the whole point of me being able to help someone is when they open up to me and they're clear about what their goals are, what their needs are, what their fears are for that matter. And, you can work around those and try to help them overcome their fears by, putting plans in place for that, contingency plans for that matter.
Yeah.
And at the same time, plan for those goals in the future, that the aspirations they have.
Correct.
I have a client who said he wants to live on a boat for the rest of his life once he retires.
Sure.
Now he has to plan for it. He has to make sure that his family is comfortable while he lives on a boat. So these kind of anecdotes or aspirations help me in putting a plan in place for the client so that he can live those dreams.
Sure. I'm going to take this opportunity to move from one situation to another. I mean, I know that you mentioned one of the clients wanted to live on a boat, but for many of our listeners, the situation, especially with the pandemic or whenever there's a financial crisis, etc., tends to come in very sharp focus as to where their money is allocated. So sometimes it's a choice between paying off a credit card outstanding or paying the insurance premium. How do you look at and advise clients to make those choices, or is there a framework that you offer, or what do you suggest clients do?
So debt isn't terrible, but it's the kind of debt you have in place.
Yep.
So if you have credit card debt, if you were a client of mine for a few years, you would obviously not have that anymore, because that's the first debt I asked anyone to pay off from the day one.
Sure.
So yes, it is a tough situation, but again, though there are you can mitigate those risks. You can go back to banks and renegotiate. Mm-hmm. We always tell our clients that don't hesitate to go back to a bank and renegotiate terms of your loans.
Correct.
And there are instances that we've seen where banks have been understanding, and they go out of their way to help the clients. They give deferrals to people for their credit card payments, for their loan repayments, etc. So the first thing is to take care of that, because as we all know, credit card debt is the most expensive form of debt in the world. So if you do not take care of that...
I'm just going to stop you on that, because I've heard that statement so many times, and I do understand a little bit of it, but if for our listeners, if you can expand a little bit on that, when you say the most expensive debt in the world, I mean, do we have any kind of numbers? Is there any way that we can sort of quantify or give an idea to our listeners and viewers what that actually sort of translates into?
Okay, so let me give an example. So the S&P 500 last year returned 60% from the bottom of the in March 2020. Now, imagine if you had to pay 50% as your credit card debt interest. Now, a lot of people don't understand how it's calculated. It's calculated monthly. It's calculated on your entire outstanding. So even if you have a payment plan on a credit card, but you're spending over and above that, they actually charge you interest on the entire amount. So no matter which way you look at it, credit card debt is the worst kind of debt to have. I mean, the numbers are scary. So I don't want to scare anyone off in this conversation, but avoid that. If you have credit card debt today, go to the bank and try and negotiate a personal loan, which can, where the interest rate is fixed and is a much, much lower scale than a credit card. Correct. And then you can, plan for the rest of your life, because you have to first survive. Only then you can thrive.
Correct.
And if you don't have money and you keep paying every single penny that you earn as interest to banks and credit cards, then you will not thrive ever. Because all your life, it's like student debt in the United States today. People are taking 25, 30 years to pay off, and that is the prime years of their life.
Correct.
And what is the point of a life like that? Yeah. So if you want to live a fulfilling life at the end of the day, you want to sleep peacefully at night, these are small things that can help you do that.
I think very, very valid and sound advice. It's easy to fall into the credit card trap. And the focus, like you correctly mentioned, I think is that as the first step, we should look at getting out of those kind of debts that are unhealthy, and before we start our financial journey. So thank you for that. And, the flip side of that is very often we hear the term or the phrase, cash is king. And you should have cash so that you can take advantage of the opportunities, etc. So last year has presented many of these opportunities. I think we've seen at the start of the pandemic, the market sort of dip, and then it's sort of gone up. And it's, let's say there's some, I'm someone who's sitting on cash. How would you advise that I approach investing? What would your what do I do? I've got the cash, but now what do I do next?
So the first thing is I would ask you to get in touch with me, then I'll tell you how to do that. But on a serious note, I think the rules don't change. Whether you have cash today or you had cash yesterday or you had cash in March 22nd of 2020, I would still say that you still have to allocate your assets in a manner that you can go through these crises and not have sleepless nights. So like they say, you should always have some dry powder. Having that gives you the flexibility to allocate your money as and when markets move. Now, the pandemic is an anomaly. The market returns last year are an anomaly. So saying that, if you had invested in March last year, you would have made 60-70% returns. Yes, that's true. But it's not something that anyone predicted.
Correct.
A lot of things happened in the meanwhile. Central banks behaved like they've never behaved before.
Yep.
The vaccine development was extremely quick. It's a miracle that they've come out with a vaccine with 95% efficacy in such short notice. And those things were not something that was priced into the markets.
Correct.
So you would have to be a really brave person to put all your money in March 2020 into the markets.
Sure.
Even I didn't. I did buy a lot of things on dips. Unfortunately, most people don't do that because, we tend to follow the herd. And when, Warren Buffett says, when the market's cheaper, when the markets fall, it's like it's on sale. So you should always buy on sale.
On sale.
But people don't tend to do that. People tend to believe that the markets are falling, they'll keep falling. Or on the flip side, when the markets are going up, people keep buying because they still are optimistic that the markets will keep going up.
Correct.
Now, trading is exciting. It's fun, as we've noticed in the last few months. Everyone's having a lot of fun in the stock markets, but finance is a serious business. And if you want to make a decent amount of money in the long run reliably, then you need to stay invested throughout these upturns and downturns, because there is no shortcut to this. I'll give you an example of Tesla for that matter. If in 2014, if you're invested in Tesla, till about last year, they would have seen a lot of fluctuations in the stock. It went up, it went down, stayed valued around, whatever was the market capitalization, didn't change much.
Sure.
But in those few years, their revenue went up from $2 billion to $25 billion and no one noticed. So now when the markets have noticed and they're expecting the stock to do even better, the stock has gone up.
Correct.
So if you bought it into 2014 and sold out in 2016, you would be regretting that today. So the best investors in the world have very low turnover ratios, which means they don't sell out from their best bets. So there's a fund manager called Ron Barron. His turnover ratio over the last 30 or 40 years is 4%.
Yep.
That means he 96% of the companies he still holds. So he bought McDonald's when it was a small cap.
Correct.
Or Coca-Cola for that matter. So these are companies that all small caps today become, not all, a few of them become large caps. But if you believe in a company and you believe that the company will do well, you should stick to it and not trade every day just for entertainment.
Absolutely. I think that especially if wealth accumulation is a goal. If you're looking at quick money and if you're looking at trading in the day, that's a completely different mindset.
Correct. So
and a different
don't
person.
get me wrong. Trading is good, but trading requires a lot of skill to make money. The markets can sometimes behave like casinos.
Yep.
And we know in a casino, the house always wins.
Yep.
So you don't want to be part of something like that with a lot of your money. So if you feel the need or if you feel trigger happy, take some of your money and this is money that you don't need.
Yep.
Yes, you can invest in or trade in the markets, but I would advise that only if you can do your research, if you can spend time on the screen, only then do that. Otherwise, I was on the trading floor in the financial crisis, so I've seen people getting washed out completely. So
correct.
I come from that background, but human beings have short-term memory. So most people haven't gone through these kind of crises before. So from that perspective, I always tell people that be careful with the money you have.
Yep.
Because once you lose those in the markets, it's very, very, it can be traumatic to a certain extent.
Which brings me to another, as you mentioned, it's very risky business, and we've seen some interest, it has sort of exploded on social media in terms of what's happening with GameStop. And I'd like your take on that. What do you think about GameStop? And especially, when you look at the platform, Robinhood, and having to inject more money into it, and the number of people that have sort of gotten into it without probably the background knowledge of what that means, and if you can give us some context to that.
Sure. So this is not my favorite topic, but I'll still expand on it. GameStop is definitely a game I don't want to play, and that is the problem today. That are you invested in GameStop, the company that runs 5,000 stores in malls selling video games, or are you buying a token for making money in the stock markets because you have free time and you've got some free money? So if you would look at it as a company, which is how a lot of hedge funds looked at it, it's a company that is losing money. They have 5,000 stores in malls selling video games during a pandemic. Now, between you and me, a lot of us don't buy video games at the mall anymore.
Correct.
We download them from the portals, and so the business model doesn't work. Sure. But there was a certain investor last year who got in at mid-single digits, and he is the founder of Chewy, the pet supply store. And he said he's going to turn the company around, and he's been writing to the board constantly that you need to change your business model. Now, based on that, a lot of people started believing, especially on Reddit forums, and a particular person known as Roaring Kitty, who dips fried chicken into champagne and on YouTube. But so he believes the stock will do really well, and everyone on that Reddit forum believed that as well.
Correct.
So now you've taken the stock up, say, let's say about 800% from its lows, from where it was in November. Now, as a company, my job is to give shareholder value. And when my stock is already up 800% and I've done nothing about changing my business plan, where is the incentive for me to go into work every day and improve my business? Because the market's already rewarded me for that.
Correct.
So some of it makes no sense to me. A lot of people thought that this is democracy in the markets. To a certain extent, yes. I mean, you can't fault people for trading in the markets as active investors.
Right.
We welcome participation in the markets, but that led to a strange anomaly, and it's not illegal, by the way.
Yep.
But what happened is when a lot of funds were short in the markets, and the short interest was actually more than the amount of free float of GameStop stocks. Then what happened is people started investing in it. So these are retail traders. Now, how do they invest in it? They didn't go out and buy the shares.
Yep.
They bought call options.
Correct.
So when you buy call options, the market maker who's selling you that option has to buy a certain amount, which is known as delta.
Yep.
So say if you have a lot size of 100 shares, 40 shares are bought by the market maker every time you buy an option.
That's
so
right.
as and when the stock kept going up, he had to increase his delta from 40 to 80 to 120, etc. So automatically now you've got people buying options, then the hedge funds having to cover their shorts by buying back these securities, which they've of course borrowed from someone to short in the markets.
Correct.
So you've got a ripple effect of retail investors buying options, market makers buying stocks, hedge funds having to cover the shorts, and the stock kept going up.
It's like a vicious cycle.
It's a vicious cycle, and it's funny that a lot of people looked at it as something that retail investors are giving it back to Wall Street.
Correct.
But at the same time, it's not rational. Yeah. I mean, we tend to forget that companies are out there to make money, and we reward them for making that money by trading in this or buying their shares.
No, I think very sensible take on that. It is interesting because the dialogue around that has, while it is sort of popularized or broadened the notion of looking at the markets, I think that's probably been the positive, that more people are considering and looking at stocks and investing. The downside is that if they've not understood it fairly well, then it can lead to a loss of money and loss of savings that they would have had, which is unfortunate.
But on the GameStop, I haven't heard a single story of someone who's lost their life savings. So you have to understand that this is when the Fed started printing money and the government started giving out stimulus checks. This is a lot of people got those stimulus checks that they probably didn't need them, and they invested those in the stock markets.
Sure.
So you don't hear so many stories of people who've lost their life savings in GameStop. Whereas, because it's interesting, everyone talks about GameStop. Let's take last week's Texas freeze, for example. The wholesale price of electricity per megawatt shot up from $20 a megawatt an hour to $9,000 a megawatt an hour.
Correct.
And a lot of people lost their life savings in that. So, it's not as exciting a story as GameStop, but there are things that are happening in the markets that we still don't see.
Yeah, and from a macroeconomic standpoint, and that is probably a lot more scarier than GameStop. Yeah, so that brings us to a thought that I've sort of been grappling with in the sense that 2020, like you said, was an unusual year in some senses. Have you seen a trend in investing, or the way people invest? Has it changed? Has it evolved? When you're looking at working with clients and with generally the markets, if you're looking at trends, what are your thoughts on that?
So I think the level of speculation in the last 1 year has gone up, and I get that feeling because when I talk to clients, everyone wants to know about trading accounts, and everyone wants to know about Robinhood because it's free.
Yeah.
Now, it's hard to explain to people that Robinhood is not actually free. I mean, there is no such thing as free. I mean, let's take Google for that matter. When we use Google search,
correct,
we get results for free. But in return, Google makes a lot of money by using our data for targeting advertising. I mean, let's be honest. Google is a massive company, and they've made money by selling the search data and using that to. Similarly, Robinhood makes money as well, and it's not free. Mm-hmm. And so I see that a lot, which is good. It's a good conversation to have with my clients and explaining to them that how trading isn't investing. They're two different asset classes, actually.
Correct.
at the same time, we've also seen a lot of interest in ETFs, passive investing for that matter.
So just hold on a minute. I mean, let's explore this Robinhood thing, because I think that's of some interest. I mean, while I understand when you're coming from, it's not free. There is a cost to it. For me, or for our viewers or listeners, as an investor, what are the risks that are there then? I mean, so while I am investing at a very low cost, or at least no obvious cost to me, but what are the pitfalls or the dangers? What do I need to look out for?
Okay, so Robinhood used to have some practices which thankfully have stopped now because of the intervention of the SEC there. But they used to do something where the most popular stocks on the platform would be highlighted on the app. So that means just because the volumes were high on a particular stock, it would be highlighted, and that could be misconstrued by someone if the stock is up and there's a lot of interest in it. That means the stock is good.
Correct.
So that's not advice. That's just
absolutely.
That's just taking a market trend and trying to make something out of it.
Correct. And so I think I get what you're saying. I mean, if someone is a new investor, someone doesn't have the sort of technical background or knowledge or the time to sort of go into and study something like that, it could easily be construed as, oh, this is something that is good and I need to put my money in it. So that's a real danger there.
Correct. And like I said, because when you put small amounts of money, it's fine.
Yeah.
But if you take those kind of risks with a large pot of money, that's where I think is the problem. Otherwise, if you're doing with small amounts, I encourage my clients that if you're really interested in stock markets, go out there, put some money in, trade, but trade only after you've read and researched the company a little bit. And if you believe in it, go ahead and do it. But don't do it for entertainment, because it could be a very, very expensive form of entertainment, in my opinion.
Okay.
But at the same time, I think these are, again, news can be a lot of noise. And what we've missed out in the last 1 year is while trading has gone up in the stock markets, there's $700 billion more in money market funds in the United States since pre-COVID.
Yep.
So that means there's a lot of cash that is still not getting invested in the markets and is being held in money market funds.
Correct.
So yes, there's a lot of retail interest in trading because last year has been an anomaly and anything you bought pretty much went up.
Correct.
Now all the beaten down value stocks are going up. So I think we have to take that with a pinch of salt and know that that is not reality every year. And markets go in cycles. If there's a boom, there is also a bust every now and then. So as long as you're prepared for it, go ahead and trade your heart out, I believe. Yeah.
Yep. I'm just going to also just, for some of our listeners who may not be as familiar or who are newer to the financial planning aspect or to sort of money market as a term, if you could give some insight into what would you say is a money market fund, and what are the other kinds of funds or asset classes that investors would be exposed to if they're coming into this side of things, and what would you recommend how do you recommend they go about learning a little more about them?
I think you can learn best by putting your money where your mouth is, as they say. But you have to start somewhere.
Correct.
And the earlier you start, the better. So there's a study that someone did a few years back, and they said if you put $1,200 only in the stock markets, say for 20 or 30 odd years, and you did nothing, and the S&P 500 grew at 9% per annum, you would have $37,000 at the end of that period. Now, let's take that $1,200 and let's do that every year.
Correct.
Then you would have about $500,000 at the end of the period. So there's a very old story about this washerwoman in the United States.
Yeah.
In 1908, she started working as a washerwoman, and she saved every penny and invested all of it. And after 75 odd years, she donated $150,000 to the University of Mississippi. Now, she made that money by being a washerwoman all her life, and she saved up and she invested it. But on the flip side, her banker later said that if someone had introduced her to equities, she would have left millions and not hundreds of thousands.
Right.
So from that perspective, I think there is no better way than to start investing yourself. You can read all you want. I mean, we went to university, we went to college, and we studied a lot.
Yep.
We studied a lot of different things. But until you practice that, you pretty much feel that you didn't learn anything that was
theoretical rather than actual.
Yes. So you need that practical hands-on experience. So start when you put your money there, you'll automatically be interested in it, and you'd want to learn more that what is happening with that money.
Yeah, and so I would assume you would say start small and get the confidence, gain the confidence.
Yeah, I mean, small is relative. I mean, if you're young, if you're just starting out, you're 25 and you've got a decent salary and you save say 30% of it, invest all of it because you've got nothing to lose right now. You've got no commitments. You can invest because the earlier you invest. And someone really smart said this, that the power of compounding is the best mathematical formula that has ever been discovered. So I think even if it is small, but start. There is no substitute to that.
And consistently. That's the second part that I got from the example that you mentioned about the lady. She was consistently saving for 75 years.
Yeah, and I mean, it's tempting. A lot of young people I see, especially in Dubai, they make good money.
Correct.
But you have to learn that you have a good life, spend the money. It's always important to enjoy your life, but also find that little bit to save every month and invest it. Saving doesn't mean leaving it in the bank. Like I said, you have an emergency fund, but over and above that, invest it. Whatever makes you comfortable, and start small, start in equities, use funds, use ETFs, whatever makes you comfortable. And you can take it from there. And there is, like I said, once you start, and you make a little money, it can be a little addictive, and it's also very, very thrilling that it's something that you've done, it's something you've created, that pot of money. Because we all strive to achieve something in life, and these are small victories that I think help make our life a little more fulfilling.
Sure, no, that's very, very true. And you did bring in the newer generation, the millennials, and many of them. Along with that, I see a trend and a lot of interest in conversations, not just with that age group, but with many others surrounding Bitcoin. I mean, cryptocurrency in a sense has generated a lot of interest. There's a lot of there's a lot of talk about it, probably a lot less understanding about what it is. So what's your take on Bitcoin? I mean, do you think that that's something that is a currency first? And do you think that that's something that people should look at, or who should be looking at it, if at all anyone?
To be completely honest, I don't understand Bitcoin completely. So I mean, I don't think anyone does. But if you take the FTC in the US, they consider it a commodity. Now, like any commodity, it depends on supply and demand.
Correct.
I think it's a little unfair to millennials to say that they are the only ones who are interested in Bitcoin.
Exactly. I mean, I started off from there because the conversation probably erupted a little more from that side, but now we've seen it spread to everyone. I mean,
correct. So, I mean, I get a lot of questions on Bitcoin from my clients, and this is what I tell them. If you have money that you don't need for the next 10, 15 years, and you have no use for it right now, take that money, buy some Bitcoin and hold it. Because none of us know where it's going to go. Like I said, it's a commodity, in my opinion, and a commodity which is valued at the end of the day in US dollars. So that means you will need real money to actually convert that Bitcoin into something worthwhile. So in my opinion, buy it, hold it, and see where it goes. And I mean, if I wouldn't say put all your money in Bitcoin, because at the moment there could be regulation that could make Bitcoin illegal. Bitcoin has its problems when it comes to money laundering issues, because there is no you can't trace it that easily. It's outside the system.
Correct.
And there is a bill in the Indian Parliament which is looking at banning any what they call private cryptocurrencies.
Correct.
So until that is clear, I would stay away from from investing in it. But I wouldn't mind people speculating in it with a small sum of money.
Sure.
But on the millennial part, I think millennials are doing something which is very interesting for us in the investment profession, is their focus on ESG, because they care about the world a lot more than our generation did.
I was actually going to come to that because we've seen a whole trend and a lot of interest go on in and be focused on the ESG sector and the companies that are following those practices and principles. So, please.
Correct. So, I mean, ESG stands for environment and social and governance. So, if these three pillars are a lot of companies today are judged on these three pillars. Let's take the example of Boeing last year. After the 737 MAX fiasco, you realize that the governance wasn't up to standards in a company like that. And when that happens, the stock market immediately punishes the company.
Correct.
And that is one of the aspects of ESG. So today, a lot of money is moving into ESG themed funds. So it has grown almost 10 times every year. So
Sure.
I think it's a great space because, listen, you want to be rich.
Yeah.
You know, all the things we do in life, especially when it comes to investing, is to make money and to have wealth. But you don't want to be rich in a dirty, polluted world, right?
Yeah.
So, or a world where the sea levels are rising and you can't go to the beach anymore.
Correct.
So, I think from that perspective, millennials have brought some sort of a reality check to us. And companies like Tesla are feeding into it. Though I still don't believe Tesla is a 100% ESG compliant company because you can't charge a Tesla without a fossil fuel electricity
In
being
some
generated. Yeah.
part of the chain, no. And just to sort of give a little bit of context to that, I think it also is from a consumer perspective, it represents the companies that are socially responsible or follow the ESG sort of practices and principles. The assumption is that these would be sustainable companies because they are doing good for the environment, they're doing good for society, they have the right kind of governance that is there in. So the chances of them continuing to sort of remain and sustain and be profitable for the longer period of time vis-a-vis or versus someone that is not actually following the best practice or in that. So I think from that perspective as well, there's a hope that these are going to be more sustainable in the long run and therefore are good picks for investing money in.
No, listen, at the end of the day, the company has to make money. You can't be only environmental and sustainable and have great governance, but you don't make any money. That's also going to get punished in the long run. So you've got to find the right balance. I think everyone's still finding that balance, and I commend the efforts even of fossil fuel companies who today are moving towards green energy. So I think it's a journey. It's going to take time, but the MSCI, for example, today has about 100 odd analysts who are measuring these metrics globally. So that makes these companies answerable, and when they're answerable to shareholders, to the markets, it'll automatically result in good behavior.
Correct.
So I think in the long run, that is a positive for our world as a whole, not just financial markets.
Absolutely. I think I see that trend spreading to more and more companies, given the interest. So it's a good sort of cycle instead of a vicious cycle. It's a good cycle to see where the investors and the stock market is rewarding companies that are sort of adopting those healthy practices. And because others can see that reward is coming, we've got the traditional companies that were in the fossil fuel sector, many of them who are looking at adopting different practices and principles of ESG in it. So it's definitely a good trend.
So I think Tesla is the poster child for most of these clean green energy sort of companies. And what that is, let's not just focus on Tesla, but what Tesla has forced others to do is look at these electric cars, EVs for that matter. And General Motors today is investing $25 billion. That's pretty much equivalent to Tesla's entire revenue into developing EVs. EVs, though, fossil fuel usage is only 7% in passenger car.
Correct.
But that 7%, we kind of miss the point of electric vehicles to a certain extent because we don't realize how much energy you can conserve by not having a gasoline combustion engine.
Correct.
Because say you're driving a Tesla or any electric vehicle for that matter, and in a conventional vehicle you'll have to step on the brakes to stop the car. In an EV you'll just have to step off the gas, and that energy that is generated by the car by its momentum, it can be stored and regenerated and used by the car itself. So the momentum is a wasted energy source today.
Correct.
Every time a truck drives on the road and it has to brake, how much energy is being wasted? So,
correct.
So I think that helps.
Sure.
Tesla's other sister company called SpaceX is going to revolutionize insulation for that matter. In a place like Dubai where we use so much of the air conditioning, better insulation technology will help save the energy cost, which will help us build a cleaner world in itself. So I think it's a great space. It's very exciting. I find I am not a big fan of Elon Musk, but I'm a big fan of some of the things that his companies are doing.
Sure. I don't think anyone can deny that. There are a lot of things that he's pushed the boundaries on and pushed conventional thinking on. So definitely he has that to his credit. let's get back again to the UAE. We've seen a little bit of a change in the business and in the industry last year with the introduction of the Bot 49 regulation. From a financial advice perspective in the UAE, how do you see that panning out for both the clients as well as for the local industry or the profession?
There are two aspects to this. At the end of the day, we want an outcome that is favorable to the client and to the advisor and to the whole community as a whole. What we are trying to do is build a community which is self-sustaining. And if you have your financials in place, you don't need to depend on anyone. Now, that is our goal. Now, when it comes to regulation, it is something that unfortunately we can't control. So I tell this to myself and anyone who I meet in our profession, that let's not focus on something that is not in your control. What is in my control is the outcome that I provide to my client.
Sure.
And that doesn't change. My advice to my client doesn't change because of a regulation. The product, if it is still the right fit for the client, I will still give it to the client. So I try not to focus on that. People who do probably aren't right for the profession. So I think that is good for the community as a whole, that it will keep people who are serious about helping clients in the profession, and it will weed out people who were in it for the short term and they looked at it more as a job than a profession.
Correct. So I think the message is quite clear. I mean, overall, it is something that is good for the industry and I keep using the word industry, but for clients. And we will see the more serious financial advisors continue to work with clients. And, like you mentioned, the objective for any financial advisor and planner is to be able to look at what suits the client's needs the best and provide him the advice on that. And that, I think, is something clients will continue to access.
Necessity is the mother of all invention. So, it'll force us to innovate. It'll force us to do a better job. It'll force us to increase our economies of scale. I think that itself is, we may not see the benefits in the short term. In the long term, I think it is all for the better. If our business is built on trust, and if we can build on that and improve the trust deficit that currently exists, I think it'll end up a win-win for everyone, including advisors and clients themselves.
Thank you for that. And I think that's a good segue into, how do you go from accumulating wealth to where do you go from that? Let's say I'm starting off on this journey. I've accumulated a little bit of wealth, and now I want to look at the next stage, which is sort of getting returns or growing that. What is the journey for someone like that?
So, when you say accumulated wealth, that could mean a lot of different things for different people. When I was 25, if I had $5,000 in my pocket, I would think I'm pretty wealthy. But again, the size and the scale may change. But the first thing you have to do is figure out that what you've called wealth, is it enough?
Correct.
And what if that wealth wasn't there? What do you need to do? How do you protect that? So you have to first preserve what you have. So how do you do that is by having protection plans in place for contingencies. Now, health is I think our most valuable asset, because that gives us an ability to generate an income.
Correct.
So if I can't protect my health, and I don't mean by just investing in a health insurance and a critical illness insurance. Invest in your health, eat better, work out, live a better life.
Yep.
And automatically that will make you healthier. And if you have a decent insurance in place, for any contingencies, that will take care of it. But say you've accumulated wealth and you've done nothing to protect it. Yep. And tomorrow you're diagnosed with a lifestyle illness that you can't ever get rid of. That is going to cost you a lot of money.
Correct.
And so that accumulated wealth can disappear as quickly as, quicker than you can imagine, for that matter. And
sure.
I think my job first is to tell people, listen, you've made this wealth, congratulations, that's a great achievement. But if you want to preserve it, first work towards that. Once we've done the job of preserving that, and that is like the foundation of any financial plan, then you can think about growing it.
Sure.
So my job is 90% risk and expectation management. As long as I can do that, I think I've done pretty much 95% of my job. And then, the rest of it, you invest, the returns are a function of the market.
Correct.
But you have to do it in a disciplined manner. You have to use asset allocation tools by not putting all your eggs in one basket, and you'll be fine.
Correct.
So I don't think the rules change. It's just the scale changes as you grow, whether in age or in wealth. So that's the difference.
So you mentioned one concept or a word there, asset allocation, which I think is very important. But I've also heard things to the contrary. For example, should you diversify your assets, and why should you diversify your asset? Or if I would like to get good growth, I should concentrate my assets on one, in one particular area which is generating the return. So what is your sort of view on that in terms of how do you approach it? Because there are merits to both, and there are obviously dangers to both. If you can expand a little on that.
So asset allocation depends on a few things. One is the stage of life you're at. So the earlier in life, the more risk you take on board. The whole point of asset allocation is to manage risk. Now, equities or stocks have a higher risk compared to bonds.
Right.
And bonds in itself have different risk categories. You have a sovereign, which basically means a government bond, which has the lowest risk.
Sure.
And then you have the high yields, etc., where you have higher risk, these are companies that are borrowing money from the markets.
Yeah.
Now, if you, in a buoyant market like we've seen in the last, let's say 10 years, because we've been in a 10 to 11 year bull market.
Okay.
Diversification in risk assets, that means diversification across stocks, would have made you money because the markets are constantly going up. Correct. So no matter which market you invested in 10 years, you would have made money in all of them.
Sure.
But it is important to diversify across assets. That means you need to have stocks, you need to have bonds, you need to have commodities, you need to have other assets like real estate, for that matter, in your portfolio. And that will help mitigate risks. Because let's say, for example, in a low interest environment,
correct,
banks don't give you any returns on your deposits. So how do you make money? So do you buy a REIT, for example, which will generate an income for you? A REIT is a real estate investment trust, which is a easier way to start investing in real estate rather than having to buy a whole property.
Correct.
Or do you, you diversify across ETFs, stocks, bonds, bond funds. So it's not static. We have to understand that asset allocation changes over a period of time. So as an advisor, what we tell our clients is, let's do a review of your assets or your plans at every year, at least twice. And then we'll allocate based on any changes in the markets. Sure. So that is something that we try and advise our clients, because asset allocation doesn't mean you allocate and you forget. It means you have to dynamically adjust and adapt throughout the period that they're invested.
Correct. And I think that would apply to financial plans as well.
Correct.
So, you need to consistently and probably at preset frequencies examine the plans that you've made and review it and look at where the goals that you've set are, and if your progress in that direction is in line with what your expectations are. So I think both of them common sense and makes a good approach to financial planning as a whole. So Abhishek, I got a call from a gentleman the other day, and while we were on the topic, so his pitch to me was, why don't I invest in commodities and forex? To which I mentioned that I thought they were extremely risky assets, and we spent a good few minutes discussing why it wasn't. He was trying to convince me that no, they're not actually risky. In fact, they are safer than equities. So I'm just curious as to what do you think about forex or commodities, because I'm sure, like me, many of our listeners are probably getting calls from different institutions to open forex accounts or commodity accounts that sort of access or allow them access to trading on these platforms. So how do you look at them, and how should our listeners consider and look and make those decisions?
So when this gentleman says that forex and commodities are safer, maybe he has a fantastic understanding of them, and in his opinion, they are safer. I don't have that understanding. I think forex and commodities trade even when I'm sleeping, and a lot of factors, have to be considered when it comes to forex. For example, geopolitical, prices of commodities. There are these are things that you can't predict.
Correct.
And if you don't have a very good understanding of supply, demand, commodity prices, etc., then trading in these assets can be risky. The other aspect to that is because these are traded in the form of options or CFDs,
Correct.
which are inherently leveraged. So that means
Correct.
On a good day, your profits can be magnified, but that will also magnify your losses on the downside. So for someone who says that it's safer, maybe for that person it is, but I would encourage people to make sure that they are aware of what they're getting into.
Right.
Because like I said, a lot of our clients have hard-earned money, and trading isn't easy. People actually do that as their day job. So if you're doing it as something that on the side, you should be willing to invest that kind of time and energy into educating yourself. Only then I would recommend anyone to get into, especially forex and commodities.
Yeah, because his whole proposition and take was that equities can swing from 0 to any sort of percentage when you look at the stock. And my argument was like that's probably the stocks that are not probably very good, and they're getting hammered and traded in different manners. And his argument seemed to be that commodities, you're going to just get a maximum 10% variation, whether it was or maximum of 20% variation from the bottom to the high. But you correctly said, I mean, there are many situations and scenarios, geopolitical, or I mean, oil prices we've seen has gone from and has certainly varied a lot more. So I would advise listeners to be cautious if you do get a call that is encouraging you to sort of look at that and is trying to convince you that it is safer than equities. And I'm assuming that you would agree that they consult someone who has an understanding of how this works.
It's with anything in life. I mean, you don't put your money into something that you don't understand, and something that you may not ever understand unless you study it. So from that perspective, I think FX and commodity trading isn't for everyone. It's definitely not for me.
Sure.
Because I don't have the bandwidth to study all of these things, interest rates, etc. These are aspects that take a lot of deep understanding to be able to take advantage of them. So
correct.
Be cautious with your money because it's your hard-earned money. But if you want to try it, do it on a small scale and start small and give it time and take the effort to learn about it before you put your money into it.
Yeah, I think that also that aspect of discipline is important, because sometimes it's easy to get carried away. A quick small win, so you need to be disciplined. You need to be sensible about things. Don't overexpose yourself to these kind of risky assets is what I would suggest.
Correct. I mean, that's what, these are basic facts of life that you have to keep in mind. I mean, you could go to Vegas and have a great day at the casino and you could lose everything the next day. So markets can sometimes behave like that. So it's important that your judgment when it comes to your money is based on your deep understanding of it rather than what you read in the news or what your friend tells you over a conversation. So these are delicate matters, and it could ruin lives and relationships if you let your heart rule over your mind. So,
well, thank you for that. And I've got one last question for you for this episode with regard to the markets. Do you think we're heading into a bubble, or is there a bubble that we're currently in? And if your answer is yes or no, why? And what do we advise our listeners to sort of approach their investments in this time?
So there is something that I go back to. In 1996, Alan Greenspan made his first, most famous speech of irrational exuberance. But it took another 4 years for the bubble to burst, the dot-com crash. And I think in today's day also, there are bubbles. And the reason I say that is because, honestly, 80% of companies that start fail. at the end of the day.
Sure.
When I just got my first personal computer, this was the late 90s. I used to use various search engines,
Correct.
Alta Vista, Ask Jeeves, etc., which most people today wouldn't have heard of. But Google came along, and Google survived. Correct. Because they did a great job of building a search engine. So 80% of companies will fail. So that means those 80% of companies at some point or the other are a bubble. But there are those 20% that turn out to be winners, and those winners take care of any losses that you make. Sure. And that brings us back to diversification. So I'll give you 2 examples of bubbles now, or the perception of bubbles. Now, Amazon, a few years back, a lot of people said, this company doesn't make a lot of money, so this is definitely a bubble. But at the same time, if you looked at Amazon, they were growing constantly without funding that growth with expensive borrowings.
That's right. Yep.
So, whereas in December, I think there is a company called QuantumScape that makes lithium batteries. Their forecast is that in 2028, they'll probably make $1 billion in revenue. The December valuation was 80 times that $1 billion.
Wow. Okay.
So, is that a bubble? Maybe, but I don't know. But in my perception, yes, that could be considered a bubble. So, bubbles are always going to be around, whether it's a good market, bad market. But as long as you're diversified, you're investing in companies that you believe will grow and have a business model that can sustain growth, you will survive, and you will make money in the markets.
Brilliant. I think that's the perfect way to sort of end this episode. Thank you so much, Abhishek, for being with us today and giving an insight into the markets. And I think we've had a very broad and engaging discussion on various topics, on finance, on investing, on wealth. And your insight has definitely been helpful. If some of our listeners want to get in touch with you, if they have questions, do give a sense of how they can reach you and what are the channels that you're on if they want to learn more from you.
So I'm available on LinkedIn. You can search me by my name, Abhishek Datta. That's Datta. I am also available on Instagram and Facebook. I have a page called The Smart Alpha. You can check it out. There's a lot of updates on that, on what I believe are important things that you should keep in mind if you want to make some money by investing in.
Thank you for that. And thank you for joining in. And if you'd like to support the podcast, I'd encourage you to look us up on the main leading podcast channels. We would be on Spotify, iTunes, and you would be able to find us on YouTube, on our YouTube channel as well. Do leave a like, do give us a review and a rating so that we can gain more listeners. And if you like the content, and if you don't like the content, do give us your suggestions as to how we can improve. That's it from us for this episode. We will be back with our episode on women and finance, which is going to cover a lot about the different needs that women have compared to their male counterparts when it comes down to finance, when it comes down to financial planning, and how do they look at and talk about and discuss these things, not just with their counterparts, with their spouses and their family, but also with the advisors that they may be interacting with. Thank you very much, and hope to see you again soon.